Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at everyone's latest stock du jour, if you will, SanDisk SNDK, and seeing if SanDisk, after a monster rally, both preceding and post earnings, is still worth the risk. And as always, taking a look at the trade, the best way to play. We always employ that fusion approach, combining fundamental, technical, and most importantly, IV analysis. So let's jump in and take a look, shall we? First of all, from a fundamental standpoint, here I pulled off a simple price to sales chart on SanDisk. This is even after earnings and the revs have been included in there. You can see trading at a lofty price to sales multiple. Certainly the growth, is somewhat worth paying that, but trees don't grow to the sky forever, as they say, and this 15 times price to sales is certainly a rich number. The stock had been chopping around 10 times price to sales until just recently, and that's certainly a large number as well. So unless revenues knock it out of the park even more, right, and they are expected to do so, but the valuation multiples certainly rich to say the least. So a slowdown perhaps to allow SanDisk to grow in to the multiple might not be a thing that is unwarranted. On a technical standpoint, here you can see the chart, an absolute monster run, but getting overbought here. We can see 9-day RSI over 85 again for the first time since back here, right? And back here was when the stock leveled off for a period of time. That's all we need for our trade, right? We're not looking for a dive back even to the 20-day moving average. We're just looking for the rally, which has been so red hot starting here, right, with the stock roughly around 600, now pushing towards 1500, right? So up 150% basically in the past month or so. So certainly a red hot move higher. You can see MACD also out over the skis, highest level by far of the year. Bollinger percent B got to one of the highest readings we have seen and has pulled back. Remember, Bollinger percent B is implied volatility base. We'll take a look at that in a second. Shares trading at by far the biggest premium to the 20-day moving average. And today's price action, where shares, opened up higher and traded just slightly higher, but ended up reversing, traded down on the day for part of the day, closed up but barely up. So this sort of kind of price pattern, that hanging man, if you will, many times an indication that the trend may be coming to an end. The buyers starting to get a little bit exhausted, and that's absolutely what we're banking on here. From an IV perspective, you can see the stock. Here's earnings. Post earnings, right? We see the stock actually heading higher here. Excuse me. But finally starting to weaken today, right? As we can see, IV finally coming down a little bit. So here was the earnings, the usual vol crush, and then the vol rush, which we always like to sell into, similar to our kind of Intel Iron Condor we did, or SMH call spread, right? Where, even though SMH is absolutely ripped higher, we're still okay on that trade. It's still out of the money. We'll see if we want to hedge it short term, but we only have a little over a week to go on it. So taking a look at IV, you can see it got certainly elevated in front of earnings. Here's the normal vol crush back down. But then since that vol crush, we've seen the vol rush, right? With IV now back over 100, which means you can get further out of the money for the same net credit on spreads. You can get the same out of the money, a bigger net credit, kind of what we like to do, give ourselves enough cushion and enough net credit. You can see the June options, the ones we chose, starting to weaken a little bit. IV still over 100, right? IV percentile still very rich at the 68th percentile compared to the actual implied or actual volatility of 43%. Certainly somewhat overstated there. Pulled off a 2-year chart on basically a slightly out of the money call, right? You can see here that the IV is trading at the highest levels we have seen over the past 2 years. Here's that vol crush and then the vol rush back in. So certainly things getting a little bit frothy again on the IV front. So here is that crush. Here's earnings, right? And then here is that past few days where we saw just IV head much higher. Everyone rushing in to think that these stocks just go up forever. We shall see. So our trade is a absolutely somewhat bearish trade, but hedge, no doubt, right? Just selling nakeds in front of this is a recipe for disaster. So the trade I'm looking at and recommending is going out selling the June traditional 1600, 1610 call spread for a little bit over $3, right? You have about 43 days to go on it, selling it for well over 100 IV, right? So we like the fact that we're getting high implied volatility, which means rich option prices, right? We're getting overpaid for our spread, right? On an overbought stock, as we said, the stock, the most overbought it has been since here, and that's when it kind of leveled off. And then overvalued too, as we said on our kind of valuation look, right? Trading at a very high price to sales ratio, right? And even though earnings, right, and revenues came in very nicely, no doubt, and are expected to grow, to continue to support this will be difficult, as the company, which is now a $200 billion company, hard to imagine a company this large able to continue to grow at that rate. So that's why we like to trade. So our maximum gain, and I'm just saying we can sell it for $300, the 1600, 1610 call spread. Maximum risk, $700, right? So the most you can lose is 700, even if SanDisk goes to the moon. Our return potential, over 40% return, right? We have 190 points roughly upside cushion from that 1410 closing price of SanDisk, right, with 1600 being our strike price. Upside percentage, about another 13%, a touch more on that, over 43 days. So we have a little over a month, right? A nice upside cushion of well over 10%, right? And a nice return of over 40%, just looking for that SanDisk rally to slow down, right? And we also have the ability to sell shorter term put spreads against our short call spread to continue to hedge if need be, similar to kind of doing a diagonal iron condor trade or a regular iron condor if you want to. So hopefully provide some insight how we go about identifying trades and putting on, the edge, if you will, and then finally putting on that hedge. We absolutely want to define that risk because, as we all know, trading is about probability, not certainty. So make sure you know where to get out before you get in, and make sure you position size accordingly. So until next time, as always, here's the good trading. Take care.